All right, and we are live. Okay,
All
so
right.
good evening. Hello. This is yours truly, Michael Stewart with Money Matters 101. This would be our second installment of Money Matters. And so in this session, a couple of things that I want to cover. We're going to take a look at a few things today. We're going to start off with, first of all, I need to make a correction to a statement that I made last week in response to a question. Someone had asked me um, if I knew anything about Forex trading, and I gave what I call a hip shot response, in that the response that I gave was not wholly accurate. So I want to clean that up for those that were tuned in last week who will see this session this week. So I was asked about Forex trading, and what I said was it dealt with the foreign exchange market. So I was correct about that. It does deal with the foreign exchange market. However, I was incorrect with the following statements that I made, because to be honest with you, I did not completely understand Forex. So I did a little bit of researching and looked it up. And so, as I said, it is dealing with the foreign exchange, but it is primarily dealing with buying and the selling of currency in exchange for another. So, for instance, if you wanted to trade US dollars for euros, that is what's being done over the foreign exchange. It is the most heavily traded market in the world. People use it, businesses trade there, and countries in whole also use it, and they participate in that market. It's a relatively easy market to get into. Uh, Requires very little capital, so you don't really have a whole lot of money in order to participate in Forex. The demand for currency is what will push the value of that currency up or down. The greater the demand, the greater the value of the currency. So it does have some very specific characteristics that I'll share with you. And that is, for instance, currencies, they trade in pairs, as I mentioned. So I'm in the cryptocurrency space, to give you an example. And so when I'm participating in cryptocurrency space, I'm exchanging US dollars for Ethereum, which is a cryptocurrency. And so the exchange shows the value of one currency and relative to the other currency. Another characteristic of Forex trading is the Forex market uses symbols to designate specific currency pairs. For instance, the euro, the symbol for euro is EUR, capital EUR. And then, of course, the symbol for the US dollar is all caps USD, USD. And then the most prominently exchanged currencies on Forex, there are quite a few, but the mostly traded ones or exchange ones are the Australian dollar, the British pound, the Swiss franc, the Canadian dollar, New Zealand dollar, and the Japanese yen. Now, I believe that I still have either 500 or 1,000 yen from when I was overseas back in 1980. It's in the back of one of my photo albums as a souvenir. It might actually be worth a little something right now. I don't know. I've had it since 1980. So each Forex pair will have a market price associated with it. So there's specific terminology that one should first get to know before trading on the Forex market. For instance, a PIP, which is a PIP, that stands for point in percentage. And then they have what is called a micro lot. A micro lot is one PIP, and one PIP is valued at 10 cents. That's what 1 pip is valued at. And then they have what is called a mini lot. And a mini lot is actually 10,000 units, with each pip is worth $1. And then you have what is called a standard lot. For instance, 100,000 units as a standard lot, each pip then would be worth $10. So it's an interesting market, to say the least. Yet experience in terms of actually participating in it. Of course, it's really very much like day trading. And so right now, I am not interested in doing day trading just yet. But as time moves on, I might dabble in it here and there. So enough about Forex. I think I've redeemed myself. Right now, what you see before you is one of the portfolios that I am trading stocks on. This is E-Trade. This is my account. So last week, if you recall, last week I showed you some things that I look at when I am considering buying a stock. Now, mind you, remember I said about 3 or 4 months ago, I started off with $64. That was my net asset for my portfolio. I had $64. That was about 3 or 4 months ago. And so as you can see today, I'm now sitting on $872. Okay, and this is investing very conservatively as well. So once again, last week there was 3 additional transactions that I did live. So let's go and take a look at that record of those transactions. They did execute. So here is the first one, AKRXQ, which was at 22 cents a share. And so I bought 10 shares of that stock. And then the other one was FUV, that traded at $5.88, and I bought 2 shares of that. And then the third one was AERO, Aero, which traded at $3.16, and I bought 5 shares of that. So as of the close of Friday, what we see, because remember, I did this over on the weekend when the market was not open. And if you saw where 2 of those stocks I had to trade as a limit order, which simply meant that the price could change at the opening of the market. And if the price went up at the opening of the market, then I would not have been able to have a successful execution if I would have tried to trade it at the price of the stock when the market closed. So remember, I set a range, well, not a range, but I selected amount a little more than what it closed at. And basically what that was indicating is that if it didn't move up to that amount, I would still be willing for that execution to go through. And so I was good to go. Monday morning when the market opened, those trades executed successfully. And so they added to my portfolio. So a week has gone by since I did that trade. So when I go to my portfolio, and let's take a look at how my portfolio progressed through that week. So as of the close of Friday, I saw a gain of $1.49 on that day, on Friday. But my total gains so far, total unrealized gains so far, is $285.52. So that comes out to about a 50.23% gain on my money. So that's pretty decent, even though as you look at my portfolio now, I got roughly, I think I have about, let's see, I got several stocks here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. I think I have about 17 or 18 stocks right now. I didn't have 17, 18 stocks when I got started, but a little here, a little there, and it grows. And it helps to diversify your portfolio as well. So as you can see, I do have some red marks there. you know, and where you see those red marks, that's basically showing where the stock went up, went down. If I were to pull it up on a graph, you see the fluctuations. But just because it's red, you see where I'm pointing at over here to the right, just because it's red over here does not necessarily mean that the stock is not doing well, okay? And to truly track the performance of a stock, you have to be thinking long-term. People who do day trading is just like gambling. You get in and you get out real quick because you don't want to take the risk of losing your investment, right? So if you see, for an example, when I bought 7 shares of this particular stock, Arrow, I bought an additional 2 shares of that stock. It was trading at $3.04. It's now trading at $4.25. So that's a gain. And that comes out to $1.89 gain on Friday. You see, and so that's something to pay attention to. Like I said, the stocks that I purchase, I intend to hold for a minimum of 10 years, unless they just absolutely bottom out and collapse. You know, but I tend to buy stocks when they are near an all-time low. That's called a bear market. And when it's at an all-time low, that's the best time to buy up as many shares as you can, especially when you're talking about a stock that has the potential to bounce back. Okay. And that's when I showed you all last week, the graph. I showed you how I look at 1 day's performance, 5 days performance, 3 months performance, 6 months performance. And if I'm still not comfortable with that stock, I'll look at a year, and I'll look out 5 years and try to see if there is a pattern. Most stocks have a pattern, and you can almost narrow it down to certain months of the year where it performs at its best, and you can see what times of the year that stock's price will drop significantly low, and you can anticipate that it's going to do something like that again. And so those are the things that I look at when I'm considering what stock am I going to invest in, and is it worthy to make its way into my portfolio. So enough about that. Unless you have some questions on that one, certainly you're free to ask your questions on that. If not, I want to go to, I want to point out some stocks that are interesting to look at. In fact, I'm now looking at them myself because they are interesting. So let me stop sharing that page and let me go to another page to share with you. Let's see. Give me 1 second here. Let me pull it up so that it can be seen. And basically, I went online, and I do a lot of researching online. So I'm not making stuff up. People need to know that, hey, they can see this stuff for themselves. All right, so you should see an article that's titled 7 Stocks That Soar in a Recession. Now, a recession like what we are seeing right now, we are in a bear market where the economy is very unstable and unpredictable. It's being driven by tweets, tweets that come from the president, tweets that come from the experts. It all speaks to how investors will behave in the market, right? But there was some events that took place. For instance, back in 2008, the stock market crashed when Obama was in office. The stock market crashed, and a lot of people sold their stocks. They didn't hold on to it. September 29, 2008 is a date to remember. The market crashed. The Dow Jones Industrial Average fell a whopping 777%, which was the largest drop that the industrial average seen. And so a lot of investors got very fearful and they pulled out. They sold their stocks and they got out, right? Which wasn't good to do, right? So what this article basically here talks about is 7 stocks that survives a recession. They have a good track record. So I'm actually taking a look at these stocks like this one here, the 2008, this stock Hasbro. You know, Hasbro is the toy and entertainment company. Hasbro's been around for a good long time. Hasbro stock, the symbol is HAS, and I'm taking a look at it now. They're reasonably priced. They're not super expensive. They've seen a 16.8% return in 2008, even though the market crashed. so if someone had several shares of Hasbro and they held on to it, they actually made some money when the market was at its worst. You know, and that's the beauty of it, is that when you understand how the market performs and the characteristics of the market, that's the beauty of it. Then you have Ross Stores, a very familiar establishment. Ross been around for a while as well also. And Ross saw 17.6% returns in 2008, which was, and it outperformed the S&P 500 by 56.1% points, you know, so that's outstanding. That's outstanding. And here's another one that performed well, believe it or not, Walmart. Walmart performed well during the crash. They saw a 20% return in 2008 when the market crashed. So that tells you that you can still make money even though the market may not be performing all that well. And so this is why it's good to have a diversified portfolio. And then we take a look at Amgen. Amgen, AMGN, is a biotech company, and they performed extremely well as well. In fact, they saw a 24.3% return in 2008. Now, Amgen is a company that deals with cancer, anemia. I'm trying to read it as I go. Clinical trials, okay. That year also brought positive clinical trial results for denosumab, a drug that would account for $2.3 billion in revenue in 2018. So even that stock did well during the 2008 crash of the market. Anheuser-Busch, you know, folks are going to drink, especially when you're talking about in the world scenarios. They're really going to drink. You know, folks were mad because when the pandemic first hit and they started shutting everything down, folks was mad because they couldn't go to church, but you can go to the ABC package store and buy some liquor. because they considered, and this was interesting, they considered having access to liquor essential more than those who, you know, go to church. And that's because they considered those persons who have a dependency on alcohol, who self-medicate that way, you know. So Anheuser-Busch, look at that. In 2008, during the recession, they saw 39.4% returns during a recession. You know, so those are the types of things that I look at, you know, when I put them on my watch list. And then I look at how much the shares are selling for. If I'm not willing to pay for it, then I would look to see what the track record looks like. Try to gauge when does that stock typically go down points. And then I try to get in when it's at its near lowest and then buy up some shares. H&R Block. Now, H&R Block is the tax return prep giant. And when I worked for Jackson Hewitt, the owners of Jackson Hewitt are former H&R Block employees, if I'm not mistaken. I might have that backwards. I think I might have that flip side. But H&R Block, tax return prep giants, they did rather well. Folks still got to get their taxes done. Just because there's a pandemic don't mean that you don't pay taxes and that you don't file them. So they did rather well during the recession. They saw a 25.8% return. So, you know, when people say, oh, the stock market is risky, you're going to lose your money, It's not worth the risk. Really, they don't know what they're talking about because they don't understand the characteristics of the market. Here's another one, Dollar Tree. Now, think about this now. 2008, the market crashed, but look at the returns that Dollar Tree saw, 60.8%, well over 50% in returns, right? And so, one would have to ask, well, what is it that Dollar Tree is doing so well that even when the market has crashed and we were faced with a recession, they were growing? Now that's interesting. They were still growing. So somebody's doing something right there at Dollar Tree. And here we are, and yet another economic strain with this pandemic, with businesses closing and companies closing up doors and not being able to open again. People are out of work, but yet and still, what do we see happening right in our own neighborhood? Another Dollar Tree being put up. So that tells you that they have revenue, they have profitability, they're a stable company, and they're doing quite well. And so, I just recently found out that Dollar Tree also owns Family Dollar.
Oh, wow. I didn't know that.
They're the same owners of Family Dollar. And it's funny because where they're putting up this new Dollar Tree is just across the street from one of their Family Dollar stores, and the employees are disgruntled about it. They don't understand the logic or the reasoning. Why would Dollar Tree put up a Dollar Tree establishment right across the street from the Family Dollar establishment, where they're going to be in direct competition? And that's only because they don't understand the business arena. You can spread your brand out to where you are capturing markets from a variety of ethnicities. Folks that go to Dollar Tree don't particularly like Family Dollar. They don't care that it's the same owner. Folks are going to shop where they are comfortable and where they think that they're getting, a good product for the money that they spent. The Dollar Tree did exceptionally well in 2008 to see a 60.8% return during a recession. So they're on my watch list as well. Then you have, now these are the stocks that held up. Again, here they go, right here. So I'll share this.
I'm gonna wash my hands real fast.
Huh?
I'm gonna wash my hands just real fast.
Okay, well, I have to keep going because I'm recording.
All right.
Okay, so they did rather well. Hasbro, Ross Stores, Walmart, Amgen, Anheuser-Busch, H&R Block, and Dollar Tree. These are stocks that did well during the 2008 recession. And so quite naturally, they are going to continue to do well because they have revenue, they have stability. They're pretty much a staple in the areas where they are. Folks are very familiar with them, and they are used quite often. People frequent there and patronize their services and products on a regular basis. So they're making money. Even though times are hard right now, they're still making money. So those are things to take into consideration and to look at as well. So now I want to talk about equities. What exactly are equities? Because you're going to hear this term come up in our session today. So equities are the same as stocks, which actually are shares in a company. That means if you buy stocks, you're buying equities. You may also get equity when you join a new company as an employee. Some companies still give, some employers still give their employees equities of the company. That means you're a partial owner of shares in your company. When the company gives you equity, you are a partial owner of shares in your company. Now, because equities don't pay a fixed interest rate, they don't offer guaranteed income. So, that's something to be mindful of. In other words, equities inherently come with risk. If you have more questions about equities, then I would recommend doing a little bit more research to get a better understanding of equities. But the basics of equities to understand is that the term equity has a different definition depending on the context. When talking about the stock market, equities are simply shares in the ownership of a company. So when a company offers equities, it's selling partial ownership in the company. On the other hand, when a company issues bonds, it's actually taking loans from buyers. So people who invest in equities because of their potential for high returns, that's one of the primary reasons why people will invest in equities, because it has a high potential for high returns. In your investment portfolio, your equity exposure is another way of describing your exposure to the risk that you will lose money if the value of the stocks you own declines. So that risk is always there. So conventional wisdom states that young people can afford more equity exposure and therefore will likely want more stocks because of their potential for sizable returns over time. This is one of the main reasons why Dr. Boyce Watkins, whose slide presentation I'm going to be showing you here shortly, advocates so strongly that young people by the age of 12 should know how to invest in the stock market, should know how to start a business, and should know how to own and operate their own business as an entrepreneur. And it's good to get them started while they are young, right? So as you near retirement, like I'm in pre-retirement years right now, so it's not like I have a whole lot of time. So I'm devoting this next 40 years or so to building wealth. So I'm kind of behind the curve, but it doesn't matter where you get started so long as you do get started. The younger, the better. So as you near retirement, equity exposure becomes more of a risk. And that's why many people, they transition at least part of their investments from stocks to bonds as they get older. And that's just a wise thing to do. Now, when I was talking about Forex and I was talking about exchanging US dollars for another currency, let me share that screen so you can see what I'm talking about. I use this tool quite often as well. Let's see. Let me expand this so I can see it. There it is. Okay. I'm still learning to navigate this thing. I'm getting better at it as time goes on. All right. So what you should see before you now, I pulled up a conversion site that convert Ethereum to US dollars and vice versa. So when we were talking about euros, so let's switch that to euros. And we'll see what 1 euro is in relativity to a dollar or US dollar. So 1 euro is the equivalent of $1.17. So when people are exchanging US dollars for euros on Forex, this here would give you an example of the value of that currency. Okay, so let's do it vice versa. So let's say if I was exchanging US currency, so I'm gonna go down here to United States dollar, and I was exchanging it for the euro. One US dollar equates to about 85 cents or 0.85 euro. Okay, and so as you can see, the euro has been going down since mid-July. So that may be a good thing for someone who's doing day trading and want to catch it while it's down and then sell it when it comes back up. Okay, so I just wanted to show you what that looks like. Okay, so let's go to Let's see, where do I want to go now? I want to go over here to this page. Let me pull this up and share it. And now we get into Dr. Boyce Watkins' uh, slide presentation, which is an outstanding slide presentation. So from here on out, now I'm going to be talking about some things that I'm learning from Dr. Boyce Watkins from the Black Business School. And I would encourage you in your leisure to check out his website, theblackbusinessschool.com. This is actually from a free stock purchase program that I'm going through, that he offers it for free and allows for others to share it with other people as well. And so I'm grateful for that. Dr. Boyce Watkins actually used to be a professor at, I believe, Syracuse University. And he has since retired from teaching there and has launched his own wealth building school. And so it's an outstanding school. They offer a ton of informative courses, of which I will be investing my time and my monies in, because it's worth it. So let's go through this, how to invest in the stock market. This is something that I think is good to know. So let's see here. Okay. All right. So what you see before you is a chart. And this chart represents the stock market participation over time. It covers a period from 1999 to 2016. And it is the percentage of US adults who were invested in the stock market. So the numbers that you see along the green line represents a percentage of US adults who were participating in the stock market. So what you see back in 1999, you had roughly about 60% of US adults that was active in the stock market, participating in the stock market back in going into 1999. But notice right around just beyond 2007, going into 2008, it was at a considerably high point of participation of US adults. 65% of US adults were participating in the stock market or were invested in the stock market. But then came the crash of 2008. And what we see from 2008 on to about midway or a quarter of the way past 2013, we see a rapid, steady decline in US adults invested in the stock market. And that had a great deal to do with the crash of the market. Folks got fearful. They felt like they were going to lose all of their investment, and they sold their stocks at lower prices than what they paid for it. So yes, they lost money. They did, right? But then right around, say 2014, which would have been Obama's second term. Yeah, that would have been his second term. 2014, we see the market start to come back up. And then we see it drop again just a little bit beyond 2016. So again, there's many factors that come into play on what will affect the market and which direction will the market move. So when looking at this chart, what we see that millions of people ran toward the market when it was doing well. And that's typically what happens. People tend to flock to the market when the market seems to be doing very, very well. But then many of them panicked and they left during the crash. And see, those are people that 9 times out of 10, they really did not understand the characteristics of the market. Because when the market is seemingly doing very well, then the price of the stock is generally going to be much higher or considerably higher than when the market is not doing so well. And so people tend to flock to it and they say, oh, it's doing fantastic. Let me help and get some shares. And then they run in and they buy those shares at a high price. Whereas those who watch the market and understand the characteristics of the market, they don't panic when they see the market moving in what they call a downswing. In fact, they get excited when they see the market going down, because now they know that when those shares, the cost of those shares drop, that's the time to buy up as many shares as you can. Where when the prices were high, you might only been able to buy 2 or 3 shares, like how I did with that one stock that was selling at 22 cents a share. And that was ideal. So I bought up 10 shares. Now, when that stock goes up, I don't know where it's going to go up to, but I'm glad that I got it while it was almost dirt cheap, right? So those who left in the crash, they missed out on that recovery. They missed out. So you saw that, there was a steady decline for about 4 or 5 years. But then what did you see? You saw it start to come back up again. And so really what they probably should have done rather than get out is they should have done one or two things. Just hold what they had and do nothing. Or when it hit close to it, as low as it can get, buy up some more. Buy up some more, right? Because the market recovered and it started on its upswing. So where most of the money was made, it was made when the market started to recover. And so those are things to consider when getting into the market. So what would Warren Buffett say about stock market flight? And this is Warren Buffett. We know how wealthy Warren Buffett is. He just acquired Berkshire Hathaway. He now owns that company. When we purchased our house, the realtor that we went through was affiliated with Berkshire Hathaway. So,
Oh, really?
yeah. And I was surprised.
Oh, wow.
I was like, oh, wow. So I actually went and looked up Warren Buffett's stock for Berkshire Hathaway. And it certainly is out of my reach, $256,000 when I looked at it a couple of weeks ago. That's for one share.
Wow.
That's for one share. So that tells me that he targets a specific type of investor. You don't want just the average everyday investor. He targets a specific type investor, right? That would be nice if I ever got to that point where I can say, yeah, I'm gonna get me 5 shares of Berkshire Hathaway at $200,000 a share. That would be nice, right? So here's what he says. He says, I will tell you how to become rich. You think he might know how to become rich?
Oh, definitely.
He's a multi-billionaire many times over. He says, close the doors. Be fearful when others are greedy. Be greedy when others are fearful. And so basically, in terms of the market and relativity to the market, what Warren Buffett is really saying here is that if you've got shares of stock, hold on to what you have. And when the market is not doing so well, don't be quick to sell it. Don't be quick to sell what you have, because that's what the fearful do. The fearful panic and then they sell. He says, but instead, be fearful when others are greedy. And really, it's almost like a race to see who can buy up the most shares. Because when others are greedy, yeah, then you should be fearful because they know something that you might not know, And so that's the other thing. Now, I don't particularly follow other investors to that degree that whenever they make a move, I make a move. But when you have a flock of investors who are buying up a stock, something's happening. Something's happening. They know something that you might not know, and it would be good to research that and find out what do they know, right? And then he says, be greedy when others are fearful. So like right now with this pandemic, people are fearful of getting into the stock market, and those that have shares are selling what they have. Those that were considering getting involved, delaying getting involved. And Warren Buffett says that's the opportune time to buy up as many shares as you can while it's low. It just makes sense,
Yeah.
It does. It just makes sense. A lot of it is common sense. So what are the most popular forms of investing? So there's three popular forms of investing. They're not the only forms of investing, but these are the three most popular. The number one on the list is stock market participation. The very thing that many of our people tend to stay away from. And yet we continue to complain that we don't have enough money to do the things that we want to do, go the places we want to go, you know, have the things we want to have, but we won't do what is necessary. And one of which is learn the stock market, you know, because it's number one on the in the investing arena. It is the most popular form of investing. Many
Yeah.
of your wealthy people have amassed their wealth from the stock market, not from their companies, not from their talents, not from, yeah, they're making money, but they've amassed their wealth, their true wealth from the stock market. So this explains most of the gap in wealth between the rich and the middle class. And the way the economy is going, there seems to be an unspoken agenda to do away with the middle class.
Mm.
You know, either you are going to be wealthy or you're going to be super poor.
Mm.
You know, and we see the middle class is fading. The lines are becoming obscure. That you used to be able to determine without confusion who fit in the middle class category. Those lines now are beginning to kind of fade away, you know. And, you know, I remember years ago, I came across some information and I shared it with people and I told them, I said, look, now that Trump is in office, this is an opportune time to start a home-based business. Why? Because he favors business. Every decision that he is making, it is to support businesses. Now, of course, your major corporations, they're going to see the bulk of those benefits, absolutely. But those that would start a home-based business can participate in certain tax credits and tax discounts that the average taxpayer will never be able to participate in as a regular taxpayer.
Mm.
You know, so buying a home or investing in a home, and it is an investment to some degree, allows for you to get tax credits as a home owner. Your mortgage interest and your real estate and property taxes are deductible items when it's time to do your taxes, and it may give you a better return than if you did not own a home, right? But if that's all the person did, they're still behind the curve. That's all they did was invest in a home. They're still behind the curve. Now, uh, um, now when you start a home-based business and you set up an office space in your business, like what I've done, you know, this is my office. This is where I conduct my business. So now what happens is the square footage of my office space within my home is considered a business expense. So the utilities, what it costs me to keep the lights on, what it costs me to keep the place cooled and keep it heated, any supplies that I buy that are directly related to the activities of my business, pens and notebooks and pads and what have you. These now become business expenses that I am not able to deduct from my taxes.
Oh, wow.
Because now the IRS says I'm a business. And so here on my door, soon you'll see a sign that shows my business hours. Because see, these are things that IRS looks at to say you're legitimate business, you know? And so you can participate in those tax credits. When I'm driving my vehicle to conduct business, to go meet a potential client, to talk to a potential client, well, my mileage is a deduction. When I use my cell phone to contact potential clients or contact business partners, the what it costs to keep my cell phone operating is a business deduction.
Hmm.
When I'm conducting my business and I'm traveling about and I stop and I get me something to eat, that's called a meal expense. That's a business deduction. You know, and see, the average person cannot participate in those tax breaks as just a taxpayer. So the stock market is the number one popular form. Market participation dropped a great deal after the crash in 2008, as I've shown. They didn't know that these are the best times to earn money. Now, the second most popular form of investing is real estate. Now, I mentioned about home ownership, and that's a good thing. That's part of the American dream, you know, is home ownership. Get a good education, get a good paying job, and own a home. That's the American dream. You know, I grew up in the 60s, and they said the American dream was baseball, hot dogs, and apple pie. And then they added Chevrolet. But the American dream that causes many people to come from distant lands to come here to what they call the land of opportunity was getting a good education, getting a good paying job, and then becoming a home owner. And we see many ethnicities doing just that. They come here by groups of families and they bond together, they pool their resources. And within 5 years, each one of them have a business, each of one of them are educated, each one of them have their new vehicles, each one of them have a home that they own, because this to them is the American dream, right? But home ownership has its limitations in terms of wealth building. Yes, a home does accumulate equity over time. It does. It accumulates equity, and it becomes worth more than what you paid for it over time. But real estate, what we're talking about is we're talking about more than just home ownership. We're talking about also owning some land, owning some investment properties. Now, real estate requires upfront capital and a bit of expertise. It's not something that you just haphazardly try out, because the losses are great, you know. But again, it's a popular form of investing. Most Americans have the bulk of their wealth tied up in real estate. If you listen to any of today's significant celebrities or artists, and if you read up on their bios, you'll find out that they are heavily invested not only in the stock market, but they are heavily invested in real estate. Many of them own commercial properties as well as duplex homes and own land, you know, undeveloped land, you know, because they recognize that, you know, these things continue to accumulate value over time.
Mm-hmm.
And then the third most popular form I mentioned already is small business ownership. And so here's what Dr. Boyce Watkins says emphatically: every Black child should know how to start a business by the age of 12.
Huh.
They don't teach you this in school.
Nope.
No, they don't teach this in school. What they teach you in school is get a good education so you can get a good job. That's what they teach in school, you know.
Yep.
And so small business ownership, believe it or not, as I've tried to share with many of my so-called Facebook friends, and I say so-called because I'm finding out people have a different definition of friend, you know.
Yeah.
And so business ownership for us, for Blacks, is critical.
Yeah.
It is. It's critical. We have got to get away from the hand to mouth posture that we are in, depending on someone else to provide us what we need. And we have to start making our own way. And so that's why I've been so adamant and diligent and continuing to try to brand myself as a business and not have to depend on a job. Now, I love my career, and I have no aspirations of leaving my career just yet, because I enjoy what I do. and it brings me a sense of satisfaction that I am pleased with. But at the same token, I don't want to be another number in the statistics of those who do retire only to go to another job to survive.
Mm.
And that's a vicious cycle that many of our people are in. They retire only to go and get a part-time job just to try to make ends meet. I want to amass wealth to where I can continue to live off of the interest of my investments and then leave a legacy for my family, for my children and my grandchildren that are coming up behind me. I'm trying to leave a heritage for you all, right? So let's talk about stock. What is a stock? So a stock is a share of ownership in a company, like cutting pieces into a cake. So when you purchase a stock, you actually purchase a part of the ownership of that company. You have a voice now in that with that company. And it comes with a right to a share of the company's profits. So when the company makes a profit, then you get to share in that profit if you own any shares in that company. Okay, and so that's what you've seen when I showed you my portfolio. Mind you, I started off with $64, and it has now grown to a little over $870. That's because those companies some of them did good, some didn't do as good, but all in all, the ones that did good, benefited me because I had shares of ownership. So when they saw profit, I saw profit, right? It also may come with some voting rights. And so every year what happens is companies sends out a voting ballot for those who have shares in that company. And they get to vote on the principal officers of the company, whether or not they'll serve another term in that company in that role. So that's where you now, as a part owner, has a voice in that company's decision and profitability. Shareholders own the company and are the ones who are really in charge. Because if a shareholder is dissatisfied with the company where that shareholder has voting rights, they can voice their discontent with the company. And if the owner of the company is not paying attention to that, they can not only just lose those shareholders, but they can potentially lose customers as a result too.
Mm.
And then that would hurt their business. And so that's why, shareholders are considered to really be the owners of the company, are the ones who are really in charge, because they can either drive more business to that company, or they can drive business away. So shareholders, they are represented by the board of directors. Corporations have a board of directors, and the board of directors have the obligation of choosing the managers. And the managers are put in place to make money for you as a shareholder. Yes, they want the company to profit, and in making money for the company, they're making money for you as well. And so that's why they're highly selective of who they choose to be a manager. It's not an easy pick. Now, when managers don't do their jobs well, what happens? The board gets rid of them. The board gets rid of them. And some companies, where they may have ignored the bad management of the managers, and the board didn't do anything about it for whatever reason. As a shareholder, when it comes time to vote, those board of directors don't have to do another term if you vote them out. You vote them out and vote somebody else in. So that's they all work hand in hand for the profitability of the company and for a shared profit in what the company makes. So it's a win-win situation for both. So now we talk about IPOs. That's something that you may hear from time to time. These are initial public offerings. Now, an IPO is when a company offers shares for the general public to buy. Generally, this is when they have just gone public and now they have made shares available. They have a certain volume of shares that they've made available to the public to invest in having ownership. And so the company, when you invest in shares of stock, what you are, not only are you buying into part ownership of the company, but now the company is using your money to further their projects. That's what it does for a company. They use that money to further their projects, their developments, and to enhance what they do as a company. So when you sell shares, the company no longer belongs to you. It is publicly traded. Okay. So when a company does that, say for instance, you start a business, and then it start off at home, kind of like Microsoft. Microsoft, they started in the garage, right? I believe it was.
Yeah.
And so it grew beyond the garage. It became what we call a brick and mortar establishment, where they looked for a suitable space because they outgrew the garage. So they needed a physical location. And so they found a physical location, and they did well. They expanded their offerings, what they were making and producing, and people wanted what they had. They saw profitability, and so they continued to grow, and they grew to a point where they offered an IPO, and they began to trade publicly. Now, yes, the person who originally started the company is the owner of the company, but the moment that they began to publicly trade, when they started selling shares to their company, then the company no longer belonged to them, essentially, even though they're the ones that started it. Essentially, the company no longer belongs to them, because now it's being publicly traded, and now people have an opportunity to own shares of ownership, right? So the shares are either offered privately, or they're offered as a part of a stock exchange. And so some companies, a few still do offer shares of their stock privately. And then others, they offer it as a part of a stock exchange. So the largest stock exchanges are the New York Stock Exchange and the NASDAQ. And the NASDAQ is the National Association of Securities Dealers and Quotations. Okay. So remember that term, equity. So portfolios and equities. A portfolio. Now, when you buy a group of stocks, you now have what is called a portfolio. So when you hear people talking about their portfolio in terms of stock ownership or investments, this is what they're referencing. They have a group of products that they've invested in, and that's their portfolio. What I've shown you on my E-Trade platform, that was my portfolio. I have about 17 or 18 stocks, different types of stocks in my portfolio. So stocks represent a form of equity. Remember, we said equity was shares of stock, meaning that you are an equity holder or an owner of the company. Now, that does something to one's psyche when you start thinking in terms of a shareholder as an investor versus a consumer. As a consumer, you really don't own anything. You use up what you buy. You just use it up. Same thing with a home purchase. Yes, your name goes on the deed, but you're not truly the owner until you have satisfied the mortgage. So as long as you're paying a mortgage on that home, the true owner of that home is the mortgage holder. And then once you satisfy the mortgage, then you get the deed of ownership. So that's why when people buy homes, and in the mid 70s and 80s, I believe it was, and going into the 90s, banks were allowing people to buy homes greater than what they could afford, and then that resulted in them foreclosing on their homes. And it showed them that, yeah, your name may be sitting on the deed, but until you have the deed, that's not your home.
Hmm.
Not your home. You're buying. You don't own it yet. You're
Mm.
buying, you know. And they proved that when they foreclosed after about 4 months of no payments going into that mortgage, then they have every right to come and take their home,
Mm.
you know. And so it's important to understand the difference between being a consumer and being an investor. So equity holders, they're not the same as debt holders. Debt holders are owed money by the company. And generally the way that happens is rather than a company offer shares of stock and publicly trade, they may offer bonds, which are actually IOU tickets. Okay, and that's what a debt holder buys. Debt holders typically own bonds, which is an IOU that is created to represent a set financial obligation with interest. So they'll sell bonds to individuals, and this is a way for the company to raise money to advance their company.
Mm-hmm.
And as a bond, when a person purchases a bond of a company, the company owes them money. When you buy shares of stock, the company doesn't owe you money. You share in their profit, but they don't owe you nothing. You buy a bond, they owe you money. Okay.
Mm.
And so that's also something good to invest in. Also, I'm looking at a couple of companies right now, and I'm considering buying a couple of their bonds, you know. And so the difference between equity and debt holders, equity shareholders, and debt holders are those companies that make bonds available. An equity
Mm-hmm.
holder is the owner of the company and gets all of the upside. So as an equity holder, a company is an equity holder when they have satisfied their costs after they looked at all of the revenue that came in from the sale of their product, their good, or their services, and then they took care of all of their expenditures, what it cost for them to operate that business, pay the salaries, keep machines running, supplies and equipment. What's left over for them is profit. That's what's left for them. Okay.
Mm.
And as an equity holder, all of that profit goes to the equity holder. And then if you are a shareholder, you get some of that profit.
Mm.
So if a company loses money, the equity holder gets nothing. So if they have a bad year, and that's reflected in the stocks, if they have a bad year and they don't turn profit, they as they say, they are now operating in the red. That means that they now have debt that is unpaid and they have no profitability, right? And so when that
Mm-hmm.
happens, the equity holder, they don't get anything. And as a shareholder, you see that's where you may see the price of that stock go down. Okay.
Yeah.
But that company may very well recover, and many have, and many do, you know. So a debt holder has a cap on his payment. He only
Mm-hmm.
receives what he is owed. Okay. So when a debt holder has bonds and the company owes them, they owe them a specific amount and nothing more.
Okay.
So the debt holder is guaranteed to be paid, whereas a shareholder is not guaranteed to be paid. A debt holder is guaranteed to be paid, even if the company loses money. So that's why, you know, having bonds in your portfolio is also good, along with having a variety of stocks. Because as a
Mm.
debt holder, say you paid $500 for a bond, right?
Mm-hmm.
And the debt hold the company would have designated a certain interest that $500 is going to accrue.
Mm-hmm.
Whether that company does good or bad, they owe you that. So that bond may be for 2 years, it may be for 5 years, may be for 10 years, right? When that term is up, they owe you that, whether they did good or bad. That is owed to you, and they got to pay it. So in the case of bankruptcy, and many companies have gone bankrupt, and they had bonds that they owed people payment on, the debt holders are paid first, because essentially what a company has done when they've issued a bond, they have borrowed your money. They borrowed it to try to advance their company. And so they owe that back to you, as opposed to shares of stock. They're not borrowing your money. You are giving them your money in exchange for part ownership, if you understand the two differences. All right, so when we talk about diversification, this is the most important rule of investing. And I think this is where a great number of people have their discontentment with the stock market, because they did not understand this rule. Diversification means you don't put all your eggs in one basket, and so that's what a lot of people who don't understand how the market works did. They bought one particular type of stock, and they may have bought several shares of that stock and did nothing else and expected to amass wealth. And that's just not how it works. It's got to be work. It's just like agriculture. It's like farming. You put seeds in the ground. Just because you put seeds in the ground don't guarantee that anything's going to grow. You got to water it. You got to tend to it. You got to keep the weeds away. You got to keep the earth treated properly with the right nutrients. And you got to water it from time to time, in order for you to see a harvest. And the same thing with the stock market. If you just buy one type of stock and that's all you did was buy that one type of stock, then your risk of losing your investment is greater than the person who buys up several different types of stocks. So that's what smart investors do. Smart investors buy several different stocks, not just one. And so what I've shown you in my portfolio right now, I'm running about 17 or 18 different types of stocks, and I'm watching another 20 plus stocks that I'm considering adding to the portfolio, right? And that's what smart investors do, is that they spread it out. They spread it out. So you spread your money into markets across the world. I've got a few stocks that are actually in Japan and in China right now, and they're doing rather well, so diversify across different asset classes and types of stocks, small companies, large companies, tech companies. I've got about 4 or 5 that are tech companies, and I'm looking at another tech company that's expected to be real big with the explosion of 5G here real soon. And so I'm getting ready to get some shares of their stock. Real estate, small businesses, gold, silver. Now, I already invest in physical gold. I'm getting ready to start investing in physical silver, but I also have gold and silver stock purchases. Now, when you buy shares of stock, those are considered to be paper transactions. And some people don't want to, some people stay away from the stock market for that reason. They don't like that investing in the stock market, you're not investing in something tangible as they see it, because they're paper transactions. There's no product is being exchanged for the monies that you are giving up, right? But you're getting shares of ownership of a company, and when the company does well, you share in their profitability. Bonds, you're getting a paper transaction that says that this company owes you this amount of money, and so I've got some stock in gold and I've got some stock in silver, and they're doing pretty well, and they weren't expensive either. That's the good thing. And basically, really, with gold and silver, your precious metals, when you invest in those shares of stock, really what you're doing is you're helping to finance them mining for gold and silver. And as they successfully find gold and silver, the stock goes up. Now, when they mine an area and they can't find no more, then it affects the price of the stock. But For physical gold, on the other hand, now physical gold doesn't lose its value. Physical gold and silver maintains its value, and it continues to outperform the inflation rate. So the results of buying and holding. This is an article from USA Today in 2011. Said the biggest annual gain with a 1-year holding percent is a plump 53.4%. The worst, a stomach-wrenching drop of 44.8%. So even though within 1 year, the market saw a tremendous increase of 53.4%, yet it experienced a decrease or a decline of 44.8%. But I would say still, you know, the market came out on the winning end because it made more than it lost, you know? So in contrast, the maximum average 1-year return is 14.4% when holding on for 20 years. But even the minimum average annual performance is positive, a 2.4% gain. So folks that just, you know, hold on to something for 1 year and they get out, they might see a little bit of increase, but the longer you hold, the greater the gains in most cases. And then this 60-year period included all sorts of scary things: the mid-70s recession, OPEC oil embargo, the 1987 stock market crash, the 1998 Asian financial crisis, the bursting of the tech stock bubble in 2000, and the just concluded Great Recession, yet gains were seen. So the lesson here really is chill, stay invested, stay disciplined, and be diversified. That's what the author of this article says, Belsky says. Chill, stay invested, stay disciplined, and be diversified, right? And so if you really want to make money in the market, that's necessary. So another statement says, by getting out of stocks, investors end up missing out on big rallies. If you missed out on the 10 best days between 1980 and 2010, which I missed out, I did. I missed out. Your average annual return would have dropped to 5.7% from 8.2%, according to Oppenheimer's report. Now that's from June 8, 2011, right? But the longer you stay invested, the greater the chances you will capture the market's uptrend, says Lewis Harvey, president of Delbar Securities. When you deal with shorter snapshots, it is like potluck if you will be a winner or a loser. 10 years, in my view, is too short a period to optimize returns and take advantage of the market's long cycles. So this is one of the reasons why Dr. Boyce Watkins, you know, advocates that young people learn to invest in the stock market while they are young. He's got a program that's been specifically crafted for young people that he calls tomorrow's millionaires. And in fact, I'm considering very strongly go ahead and investing in that course on your behalf. And you go through it at your pace. It's a worthwhile investment because he pulls all the stops out and shows you all the ins and outs that you would need to know to be successful and invest in the market and building wealth. And for young people, you can withstand the greater risks because you've got years ahead of you, you know. And so there's a formula that he talks about the time value formula, the value of time, right? And so I'm looking at getting that program for you so that you can start gaining some of this knowledge directly from Dr. Boyce Watkins, and it'll be something you can share with your peers and let them know, hey man, this is something that we all need to be taking a look at, you know. So here's what the experts say about investing. Again, Jeremy Siegel says, now he's a professor at the Wharton School and author of Stocks for the Long Run. He says you will greatly improve your chances of posting gains over a 20-year period if you buy the bulk of your stocks when they are selling cheaply. Okay, so I tend to listen to the experts. I tend to listen to their advice before listening to one of my peers who knows absolutely nothing about the stock market. you know, I remember when I first started getting back into it, and I was talking to a couple of friends, and I told them, "Say, yeah, man, I'm getting ready to get back into investing in the stock market." And they're like, "Oh man, I don't even mess with that thing, man. That thing is too risky." But they go out and they buy lottery tickets. And I said, "How long have you been buying lottery tickets?" And one of my peers, I can't even say they're really friends, but one of my peers, they've been buying lottery tickets for close to 15 years.
Mm.
I said, "How often did you win?" He said, "Well, I won a few times. I won like 500 here, 1,000 there, $2 here, $10 there." I said, "So have you ever really sat down and calculated how much money you spent on lottery tickets versus how much you actually won?" And you'll find that if anything, you didn't even scratch the surface of winning back what you paid into.
Mm.
And see, they don't look at it like that because as a consumer, you're not thinking, the consumer's not thinking about that. They're not thinking about, the future value of money. And there's a formula that tells you what the future value of money looks like, you know. And so, but yet they want to give you advice about the stock market. They want to give you their advice why you shouldn't participate in the stock market. I don't listen to them. Those are not the people that I listen to. I listen to those who are actively participating in the stock market, those who are considered to be the experts, those who have the knowledge base, those that understand the market. I tend to listen more to them. And so that's one of the main reasons why I enrolled in Dr. Boyce Watkins' free course, because I wanted to hear from an expert. He's a professor, he's a psychology what is it, psychology, finance expert, you know, and he's knowledgeable and his team is knowledgeable. They know what they know, right? So Siegel goes on to say that it's not wise to buy stocks when they are super expensive. Like right now, I'm looking at Tesla. Now, a couple of months back, when I added Tesla to my watch list, because Tesla has becoming a rather popular vehicle. They're in competition with another non-known company right now. Their stock right now is roughly about $1,500 a share.
Mm-hmm.
Same thing with Google. Now, I kind of wish that I'd have gotten into Google some 20 years ago when their stock was cheap. Google is running about $1,400 a share.
Oh, wow.
Yeah. So that's why they say, now's not the time for me to buy those stocks. Now I am watching to see if they go down and see how far down they go. I may consider it if they drop down to $500 because there's the potential that they may bounce back, but I'm not paying over $1,000 for a share of stock. No, I'm just not there. Now, if I was young and I had money coming in like that, I probably would jump on it, But as he says, that's not the time to buy, not when they're super expensive, such as when they were selling at more than 30 times their earnings back in the high flying 90s. Winning strategies include dollar cost averaging. And that's a term that you need to be familiar with. Dollar cost averaging, which entails buying stocks on a regular basis. This is how compound interest comes into play, allowing you to buy more shares when they are cheap and fewer when they are pricey. So dollar cost averaging, you're looking at the cost of the stock day to day. And as long as the price is low, buy. When the price starts jumping up, hold what you have. Because you're making money. And then when the price starts going down again, buy. You see, that's why we call that a buyer's market. That's a bear market. when prices are low. That's a bear market, and that's the time to buy. A bull market, the market is raging. The market is raging. Prices are soaring. They're going through the roof. That's not the time to buy. That may be the time to sell if you have to, but that ain't the time to buy, right? So investors who deploy their cash only during end of the world scenarios also tend to do well, Siegel says. In other words, like right now with this pandemic, we saw it in 2008 when the economy took a swing, a dive, and the market crashed. People panicked and they sold their stock. Others benefited from that. They bought up a whole lot of shares at cheap prices, and they made a lot of money. You know, folks tend to respond to end of world scenarios. They either panic, or those that understand what's going on is going to get involved and they're going to buy up those shares. The psychology of human beings works against staying in the market. People, our people in particular, a great many of us either won't even try the market or don't want to go nowhere near the market, or say that we have tried the market, didn't understand what we were doing, felt we lost too much money and we'll never do it again. You know, the psychology of human beings is what, you know, keeps people from staying in, you know, just like with relationship, you know, you know, you have good days, you have bad days, but you got to make a determination. Is it worth holding on to? You know, and the way psychology works in people, when it comes to the market, they see a bad day, they ready to get out, you know. But Siegel goes on to say, to stay in the market for long periods, you have to have blood like ice water. You got to have blood like ice water. You can't be moved by what you see. You've got to look beyond that and understand what's really into play. So now we take a look at what is called average price earnings ratio. This is a historical view of that from, I believe that's 1880 to 2010. And so what that simply represents when you talk about average price ratio, the higher the price earning ratio, investors are willing to pay higher prices based on growth expectations. So what this is saying is this, look, okay, so you see that real tall peak right there in 2010?
Yeah.
Okay, so it kind of reached its maximum during May of 2009 of 123.73, right? The current S&P 500 P&E ratio is 26.20. So that's a huge uptick. And generally what happens is certain companies may show to be promising, and therefore their stocks are priced more than what they are actually worth. And some investors would buy those stocks, and they buy those stocks on an expectation that the company is going to experience good growth. They don't know for sure, but it shows to be promising. Okay, so that's where average price earnings ratio really comes into play. Investors tend to watch that, and then they tend to look at those companies and they try to determine, okay, yeah, the price of this stock is $50 and it's $30 more than what it's really worth, but I'm gonna go ahead and buy it at $50 a share because I believe this company is going to do really well. I believe it's going to grow. Now, the company may not do well, it may not grow, and then they would have lost, as opposed to the person who would have purchased that stock when the price was low and said, now let's ride this thing out and see how this company does. They would have made some money along the way. You see? So price averaging, price earnings ratio is something that investors look at. Okay. So what is the Securities and Exchange Commission? Now, this is better known as the SEC. The Securities and Exchange Commission, they are the entity that polices the stock markets to make sure that the stock market is safe for everyone who's investing in it. So there are certain rules and guidelines that companies have to adhere to. Anyone that is offering any type of equity or stocks or bonds or products on the market there's rules that they have to adhere to, and that's to make it safe for everyone that's going to invest. They are in place to protect uninformed investors from the sharks. Like for instance, what's his name? Bernie Madoff, and he made off for real. He took investors' monies and never invested it.
Mm.
Never invested it, you know. And here they were thinking that their money was being put into a high performing investment. And what was happening was as he got new investors to invest, he used their monies to pay the other investors on the promise of the interest that he said that they would see on their money. And, you know, that's called a Ponzi scheme. And there are programs out there right now today that have those same characteristics where people, you know, boast of getting involved in a program where you give up a certain amount of money, and then after a few weeks or what have you, or months, you're going to get back a larger amount than what you gave initially. And they don't realize that according to the SEC, they are viewed as a Ponzi scheme.
Mm.
And so the SEC is in place to protect the uninformed investor, people who won't do the due diligence like I do. I do due diligence. You present a money-making program to me, I'm going to do my due diligence. I'm not going to just jump right in. I'm going to do some due diligence and see, is this thing legit? And is there any truth to it? Is it properly regulated? What are the protectors in place, if any? And if those things aren't there, I'm not putting my money in it. No. So anyone offering equity to the general public is subject to the rules of the SEC. And I shared that information with a couple of people I know that are involved in a program that is identified by the IRS as a pyramid scheme, identified by the federal government as a illegal operation, and identified by the SEC as a Ponzi scheme. And yet they still, you know, do it. That's all power to them, but I'm not. So the SEC, they forbid insider trading or trading with information that is not available to the general public. Those are forbidden activities. Insider trading is folks, only those within the company and the higher echelons of the company know about the stock, and they are the only ones that have access to it. Or trading with information that's not available to the general public. They get to buy it before, you know. So a lot of these things are the SEC, you know, watches and has rules against. So all investors are given access to an annual report. This is another test that, you know, when people are presenting things to me and, you know, anything involving investing money, you know, I want to see the annual report. How did they do last year? You know, when you buy shares of stock, companies must issue an annual report. And these are discussed at the shareholders meetings, right? So the report provides detailed information about the financial condition of the company. That way you can see how the company is doing in the market, how they economically, are they economically sound? Are they strong? You know, are they a viable company? And they have to make this information available. You don't have to read it, but they have to make it available. So that's the good thing about it. You know, like my retirement program, every quarter they send out a prospectus to let me know how my shares of stocks are performing in my retirement account, you know. And so it's good to know. So there's two types of stockholders. You have what is called a common stock, and then you have what is called a preferred stock. Common stock has voting rights. They're also paid last on the list. So if a company goes belly up, if you're a common stock holder, you'll be paid last. The debt holders are going to be paid first, and then those who are preferred stockholders are going to be paid next, and then the common stockholders will be paid last. And then as a common stockholder, you may or may not receive a dividend. To my surprise, Friday, when I went to check my portfolio, I got an alert that told me that I had earned some dividends from one of my stocks. And I was surprised because I didn't know that that particular stock actually earned dividends. And so
Mm-hmm.
I have it set up to where it will automatically reinvest whatever dividends I earn right back into the stock so I can earn more. So then you have your preferred stock holders. Now with preferred stock, there are no voting rights, but preferred stockholders are paid before common stockholders and after debt holders. And then as a preferred stockholder, you receive a guaranteed dividend. Preferred stocks do have dividends that are issued, and those are guaranteed. So some of the pros and cons of both of these, for common stocks, the issuer cannot recall the stock from the holder. When you have a common stock, the issuer, which would be the company, they can't recall that stock back. Once you own it until you sell it. And then common stock does not have what is called par value. Now, par value is a face value that is stated in the corporation's charter. So when you own common stock, it doesn't have par value. It doesn't have a face value. And then with common stock, there's moderate to high investment risk. There is. Any particular stock, you are at risk of that stock not doing so well and you losing some money, so that's a give me. Now with the preferred stock, the pros and cons there, the issuer, which would be the company, can recall that stock at any time and you have to surrender it. So I'm pretty choosy about preferred stocks. I don't believe I have any preferred stocks in my portfolio. For that very reason, I don't like the idea of them being able to recall that stock and then you're out. you had potential money and then they took it back. We call that Indian givers. So then you have, now preferred stock does have a par value, and that would be spelled out in the corporation's charter, what that value of that stock is, okay? But there is also a higher risk with preferred stock than there is with bonds, but a potentially lower risk with preferred stock than what you would have with common stock. So preferred stock are not as risky as common stock, but they do have a slightly higher risk than a bond would have. So those are the pros and cons of the two. That's something, again, you can read up on and get more information on, expand your information on those as well. So you already have the Robinhood app. I've not explored Robinhood. I've not explored Acorns, and I've not explored Stash app. I've heard of each of those. I just don't have any room on my phone to put any more apps to try them out. I was perusing Cash App last night. I see where Cash App, you can buy stocks through Cash App. So really, a lot of these different platforms have made it possible for anybody to become active in trade and investing in stocks. Little money, it don't take a whole lot of money either. And so this is from Dr. Boyce Watkins' course that I'm taking. This was actually an exercise that he challenged us all to do, to try to do this, but being that I already had E-Trade and I was already doing these things, so I would say set a goal of about $25 per week if you can.
Okay.
Set a goal of about $25 a week, transfer that over into your investment account. Okay. Set that over to your investment account and then start looking at some stocks. Look for some stocks that the prices are low. Remember how I showed you that graph, how to track a stock's movement?
Yeah.
Idea of how that stock performs at different times of the year.
Yeah.
Find some stocks that you are interested in that are low cost, and then you pull from your investment account to buy shares of that stock. And that way you can get accustomed to the app that you are using and make it a habit. Make it a habit, every day I take a look at my portfolio, see how it's doing. And then every payday or thereabouts, I move money from my checking account and to my investment account. And, usually I just move about $50 a time. I don't move a whole lot. $50,
Okay.
move $50 every pay period over. And then I think I'm sitting on about $18 that I can still buy some stocks with if I choose to, which I will before the weekend is over.
Mhm.
I will. Okay. And then I want to encourage you to read cnnfn.com. That's cnnfn.com. I want to
Okay.
encourage you to read that and try to look for some of the terms that we've discussed today as well. And so that kind of will get you started and get you on your way and continue to make sure that you're looking at your portfolio on a daily basis, just so that you are aware of what's going on, how things are moving. And don't get nervous. Don't get nervous if, from day to day, the stock goes up, then it goes down, it goes up, then it goes down. Don't get nervous. That doesn't mean you have to sell it. Okay.
Okay.
All right. So I'm going to come out of this screen share. And if you have any questions, I'll entertain a couple of questions. Maybe one or two questions. I don't want to hold you too much longer.
So like, how do you find, I guess, like a good performing stock, like a stock that you can tell is gonna drop low and then like spike high?
Okay, so a good starting place. Think about the places where you are currently spending your money.
Okay.
Places where you're currently spending your money, right? So you have the name of the company. So what you would do is you would type in Google in the address bar, the search bar, you would type in what is the stock symbol for, and then the name of the company. And it's going to give you the stock symbol. And so then what you can do is you can go on your app, Robinhood, and you can put that stock symbol in, and it's going to pull up that stock. And then you should be able to see the chart. And so I recommend first start off looking at, okay, how did that stock do in a 24-hour period?
Okay.
And what is the asking price? If I were to buy this stock today, how much does this stock cost me, right? So let's say, for instance, you see a stock, a company that you're already buying things from, and Friday, since Friday was the last market day, let's say Friday that stock was selling at $17.15 a share, right? So I would look at the day before, that Thursday. Okay, so did it go up or did it go down? And that's what that chart is going to tell you. Then I'm going to look at a 5-day record. So now it's going to go back 5 days up to that day, that current day. So now I'm going to look at it over a 5-day period, and I want to see how did that stock perform over a 5-day period. If it shows me a steep incline, then that tells me that people were buying that product up. They were buying from that company, right? If it shows me a very big dip, that tells me something happened in the economy. Folks got nervous and they started selling shares. They weren't buying stuff from that company, right? But then a 5-day period is going to tell me whether or not that particular stock had potential to recover and bounce back. So that's the up and down.
Okay.
That's that up and down that you see. That tells you, okay, this stock had a good day, had a bad day, but it has potential to continue to recover. So then like I did when I went to the 1 month, now I want to see, okay, so how did it act over a month, right? That's going to give me another snapshot of whether or not this stock is sustainable, right? And then I did the 3 month and then the 9 month, right? And so those are things that I look at to kind of gauge whether or not is it worth the risk. Now I'm looking at what is going to be my risk factor if I buy this stock. So if it shows me that it performs well, it climbs, it drops, it climbs, it drops, but it is consistently recovering, right? And if it shows me that and it's still at a fairly low price, then yeah, I would consider go ahead and get me a few shares of that stock. And then I'm going to hold it because I know that this stock has the potential to recover when it has bad days.
Okay.
Okay. So that's a good starting place. And remember, you're not in a race. That's the good thing about it. You're not in a race
Yeah.
to earn the money, to get the gains, because this is long range, you know.
Yeah.
So that would be a good starting place. So I would, if I were you, I would make a list of all of the places that I spend my money. And then I would look up their stock symbols, and then I would start taking a look at their stocks and put them on my watch list. I think Robinhood allows you to have I think it has a watch list. I'm not familiar with the app itself, but I would put it on my watch list so that I can watch it from day to day. And then when I'm ready to buy, then, I'll go ahead and buy me a few shares, and then I'll take it off my watch list because now it's in my portfolio once I buy it.
Mm-hmm.
Okay, make sense?
Yeah.
Okay. All right.
All right.
All right. So like I said, designate a certain amount of money. If you can do 25, good. If you can do 15, just designate a certain amount of money every pay period that you're going to move over into your investment account. And that's
All right.
That's going to be your stock purchase money. And of course, as you see bonuses come in, then you move a little bit more over. Okay.
Okay.
All
right,
right.
cool.
Well, that concludes today's session. Thank you so much for coming on board, and hope I've answered your questions and given you some useful information. Until next Saturday will be another good session. Next Saturday, I tell you what, we are going to take another look at how shares of stocks are purchased. We're going to take another look at that. So I may do another live purchase. Repetition is good in this arena. Okay, so I'm going to do another live purchase because, like I said, there are a couple of stocks that just came to my attention that I'm looking at, and I kind of like what I see, and I think I'm going to be investing in them by next week.
Okay.
All righty. All right. So thank you so
Cool.
much again. Peace and blessings. Have a great evening.
All right. See you, Dad.
See ya.